Hello everyone, welcome to my channel. Most people believe the next global economic collapse will happen because of debt, inflation, or central banks losing control. But what if none of those are the real trigger? What if the system doesn't break where everyone is looking, but somewhere much quieter? In this video, I'll show you why the 2026 collapse wasn't mispredicted, but why almost everyone is watching the wrong thing. And once you understand this mechanism, many global events will suddenly make sense. When people talk about a coming economic collapse, the same explanations always appear. Record levels of global debt, aggressive interest rate hikes, geopolitical tensions, and a slowing Chinese economy. These factors are real. They are measurable. And they are easy to turn into headlines. But here's the uncomfortable truth. None of them actually start a collapse. They amplify it. Debt does not break the system by itself. High interest rates do not automatically cause collapse. Even recessions, historically, are often survivable. So why do major financial crises feel sudden and uncontrollable? Let me ask you something. If debt alone caused collapse, why didn't the global system fall apart years ago? Why does it always seem to break unexpectedly, even when the risks are already visible? The global economy functions on one fragile assumption: trust. Not emotional trust, but contractual trust. The belief that obligations will be honored tomorrow. Every loan, every bond, and every financial contract depends on this assumption. But trust alone is not enough. It must be insured. Beneath the visible economy exists a dense web of guarantees, collateral agreements, and risk transfers that quietly keep money moving. Think of it as an invisible lock holding the entire system together. As long as this lock works, trillions of dollars can circulate every day without panic. But what happens if that lock weakens? What happens when institutions begin to question whether counterparties can actually deliver? This is where crises begin. Not with bankruptcies, but with hesitation. History is very clear on this point. In 1929, markets didn't collapse because people suddenly realized companies were worthless. They collapsed when credit tightened and trust evaporated. In 2008, the system didn't break because housing prices fell. It broke because no one trusted the guarantees behind mortgage-backed securities. Interbank lending froze. Liquidity vanished. The problem was not money itself, but the mechanisms that allowed money to circulate safely. Even in 2020, markets didn't panic over the virus alone. They panicked when liquidity disappeared. Central banks intervened not out of fear, but because the invisible plumbing of the financial system was clogging. So here's the key question. If every major crisis follows this pattern, why do we still focus only on debt and inflation? Today, the same quiet pressure is building again. Financial institutions are becoming more cautious. Collateral requirements are rising. Risk is being repriced across the system. None of this makes headlines, yet all of it directly affects how freely money can move. When insurance mechanisms become expensive or unreliable, lending slows. When lending slows, businesses struggle. When businesses struggle, employment follows. By the time the public sees the damage, the mechanism has already failed. This is why a collapse doesn't announce itself with a countdown. 2026 is not a prediction. It is a potential consequence. The real question is not when. It is whether this mechanism can survive growing stress. The real danger isn't a single event. It's not one country, one central bank, or one market crash. The real risk is synchronization, when multiple parts of the system lose trust at the same time. Once that happens, interventions become slower, weaker, and less effective. This is why economic collapses feel uncontrollable. By the time they are visible, the system is already frozen. Understanding this doesn't mean panic. It means clarity. Instead of watching surface-level indicators, we should ask deeper questions. Is trust still insured? Is liquidity still flowing? Are institutions still willing to lend without fear? Because history shows us something uncomfortable. Collapses don't begin with noise. They begin with silence. Once you understand this mechanism, the way you interpret economic news changes completely. Interest rate decisions stop being just numbers. Bank failures stop being isolated events. Even market volatility starts to look less random. They become signals, not causes. Signals that tell us whether trust is expanding or contracting beneath the surface. This is why focusing only on surface indicators can be misleading. Strong growth numbers can exist alongside rising fragility. Calm markets can hide deep structural stress. The system often looks healthiest right before the pressure becomes visible. That is why awareness matters. Not to predict exact dates, but to understand direction. Because the earlier you recognize a weakening mechanism, the less surprising the outcome becomes. If you like this video, don't forget to leave a comment and subscribe to the channel. Your support really helps the channel grow, and I'll see you in the next video.